Hello, in this segment, we're going to spend some time talking about various financial tools that are considered interest-bearing assets. So when we look at interest-bearing assets in our economy, we have a few. We can think of them in the form of bonds, stocks, savings accounts, certificates of deposits, and time deposits. All of these assets return some portion of the people's money or investments as interest income. So essentially, we think of these as savings tools in economics. You might be familiar with them as financial investments, because when you put your money, for example, into a savings account or a certificate of deposit or a time deposit, all of those are issued with a bank. And the bank is required to pay an interest back to you based on the balance that you have in your account. That would be considered interest income. Essentially, you leave your money alone for the agreed upon time, and that money accumulates interest. Similarly, we're going to talk about today bonds and stocks. So bonds are considered certificates of indebtedness, whereas stocks give you part ownership in a specific company. What we observe is that people get interest back, returns back on these financial investments. And we want to explore that in a little bit greater detail today. Let's start our discussion off with bonds. As I had mentioned, these are what we call certificates of indebtedness. And they can be issued either by corporations or by governments. Let's start off with the corporations first. So corporations can issue bonds to raise funds for an investment project. So let's think of an example here. Let's say that we have a large corporation that's trying to build a new factory. It can issue bonds so that people buy those bonds and essentially give the factories or the business their money on loan. Eventually, the business has to pay those bonds back, the principal of the bonds back, and they have to pay interest on that back to the individual that has purchased the bond from them. They're able to raise funds by issuing these bonds and use those funds to build their new factory or expand their business. Similarly, governments can issue bonds specifically to try to cover the shortfall in tax revenue. So when we think about a government's budget, it has to balance the tax revenue that it generates from the taxes that it collects from its constituents with the money that it spends on goods and services, or government spending. So if the government is spending more than it is generating in tax revenue, well, that shortfall has to get covered somehow. The government issues bonds to be able to cover the difference between its spending and its tax revenue. So what we want to think about today is, how do these bonds act, and what does it mean when people are holding bonds? So what we see is that over the time to maturity, either the corporation or the government has to make interest payments to the bondholder. At the time of maturity, the principal has to be repaid. Hence why this is considered a certificate of indebtedness. At the end of the bond period, which can be anywhere as short as 3 months and anywhere as long as 30 years, at the time of maturity, the principal has to be repaid by the corporation or by the government. Over the time to maturity, the government or the corporation makes interest payments to the bondholder. So essentially, we can think of this as the bondholder giving a loan to the bond issuer. They do not own part of the company or part of the government, but they're essentially loaning money to either the company or the government. So what are some factors that would affect the bond price? The first one is time to maturity. The longer the time to maturity, the higher the bond price. The reason for that is because the bond holder, the person that has purchased the bond from the corporation or from the government, has to part with their money or their funds for a longer period of time. So you need to be compensated for the fact that you can't touch your money for 10 years, 20 years, 30 years, however long the time to maturity is for that bond. Secondly, the riskiness of repayment also affects the bond price. So If this is a safe bond and you are almost guaranteed or there's a very low risk that you will not get repaid, well, the bond price will be fairly low because you're not really risking anything by putting your money into that bond or holding that bond. You know that at the end of the bond period, there's a very high probability that you're going to get your principal amount back. On the other hand, if it's a risky bond and you don't know if you're going to get the money back at the end of maturity, then the bond price is going to be higher because you need to be compensated as the bondholder for taking on the risk and giving your funds in the form of a loan or debt to the government or to the corporation. If there's a risk that you won't get repaid at the end of the time to maturity, you want to be able to be compensated for that risk. Third, interest rates. So when interest rates are high, you can gain more interest income by putting your money into other higher interest-bearing assets. So therefore, if there are higher interest rates, we expect there to be lower bond prices. Next, we want to think about stocks. So stocks are different than bonds because with a stock, when you own a stock, you're essentially owning part of the company. So stocks are only publicly traded, issued by only publicly traded companies. So companies that are publicly traded on stock exchanges are ones that have issued stock, and those stocks are then available to be purchased by the general public. When you hold stock in a company, you're essentially a part owner of that company. What influences the value of the stock is the expectations of profitability of the firm and supply and demand for that stock. So if you anticipate that the company is going to be doing really well over the next 6 months to a year, the value of that stock is going to be higher. And of course, corporations whose stock is in high demand are going to have higher stock prices. So we see that the stock price is going to be reflected of the expectation of profitability as well as the supply and demand of that stock. This is just a short video to talk about different financial tools and different interest-bearing assets that we have in our economy with a focus on bonds and stocks. For more information, be sure to take a look at the textbook and go through a couple of the exercises associated with this part of the course. Thanks so much for joining me.